Hello everyone and welcome to Homework 3, the review of corporate bonds, summary of cost of capital and capital budgeting. This is our third case in finance that we're going to be going over today. Let's review the question. Cummins Engines is considering two alternative investment proposals. The first proposal calls for investment in plant and equipment to produce a new alternative fuel engine. The second proposal for the investment in the plant and equipment to expand production of a current successful diesel engine. Cummins will choose only one of these projects since they are familiar with similar markets. Next up, you'll see that he's given us two proposed projects. One started off with $65 million, the other one started off with $20 million, for a total of $35 million and $9 million respectively. And now we're going to kind of go through here and read the question and kind of pull out the important data that he gives us. Use the following information provided below to calculate Cummins' weighted average cost of capital, or I like to call WACC, to evaluate these two proposals. The following questions are asked to provide a guide for your analysis. The WACC can be estimated based on Cummins' long-term capital finance sources, including the use of retained earnings and the use of proceeds from the new issues of corporate bonds, preferred stock, common stock issuance costs for the new issues are 3% of the new issues of corporate bonds, 5% of the new issues of preferred stock, and 12% of the new issue of common stock. So these are all important. We got to remember our flotation costs are going to be 3%, 5%, and 12%. Cummins' target capital structure is 35% debt, 10% preferred stock, and 55% equity, also something to hold on to. Cummins' marginal tax rate is 32% and has $55 million in retained earnings. As we scroll down here, we see corporate bonds is up next. That Cummins can sell an 8.5% coupon over 30 years, paid semi-annually, for $912.35. We want to hold on to that. The rest is the risk premium is for the current common stock is 3% above its bond yield and based on other companies in Cummins risk category. Cummins preferred stock sells for $28.5 per share. The dividend is 8% and par value is preferred stock is $50. On the common stock area, Cummins common stock sells for $18.47. The growth rate is 7%, and Cummins just paid a dividend of last year in the amount of $1.52. Cummins common stock has a beta of 1.5 for the general market. The risk-free rate is 3%, and the average rate of return from the market is expected to be 13%. Wow, that's a big one. So what's really important here? We're going to pull out our flotation costs at 0.3, 0.5, and 0.12. Our capital structure, we're going to hold on to at 0.35, 0.1, 0.55. Marginal tax rate is 32%. Our retained earnings are $55 million. Then we're going to break down the corporate bonds at a corporate coupon rate of 0.085. The NPER, or year, is 30. We're going to multiply that to 60 to adjust for that semi-annual rate. The risk premium is equal to 0.03. Present value is equal to $912.35. Preferred stock, we're going to be at 28.5. The dividend rate is 0.08, and the par value is 50. For the common stock, we're going to take the present value at 18.47. The growth rate's at 0.07. Dividend is 1.52. Beta is equal to 1.45. The risk-free rate is 0.3, and the rate of return is 0.13. Wow, that's a lot of numbers. All right, well, thank God we have a nice handy-dandy worksheet to kind of help us out with that. So what we're going to do is take all of those numbers and put them into this nice little Excel spreadsheet that I've created for everybody. So first off, we're going to enter in our semi-annual rate of the corporate bond, which we said was it's a semi-annual, so we're going to put a 2 in there. The NPR was set to 30. The bond price is set to 912.35. The flotation is 0.03. Coupon 0.09. Tax rate 0.32. Risk premium is 0.03. And what you're going to basically do is fill in all these Excel sheets with the numbers that have been provided from the statement. It's very easy to do. You kind of follow along and say, okay, my preferred stock, our selling price is $28.50. We're going to put that inside cell F9. And what it does is it calculates every question we could ever possibly want to know about this. So let's go over this retained earnings discounted cash flow. The first question I know is after cost tax, but I kind of broke down with the RS models first. In order to figure this out, we're going to be taking the dividend plus our growth rate, which is equal to 1.7 divided by 18.47, which is what our current present value is, plus our growth rate again, giving us a total of 15.81. Next up, we're going to be doing the CAPM of the retained earnings. So we're going to enter in a risk-free rate here. And again, this is all you have to do is just enter the values above, and it will automatically populate to the cells below for you. The CAPM formula will be the risk-free rate plus the beta times the market return of 0.13 minus the risk-free rate, giving us 17.5. The retained earnings, which is that bond yield, whatever, I think it's like question 4. And basically what we're going to do is, this one is a little tricky because before we could use the goal seek method in order to figure that out. However, we're not going to be able to do that with this because of the way that the payments and everything else are calculated inside here now. So let's go over to the tricky section of this, which is the rate perspective. So in order to figure out the rate of this, which is really what is causing all of the issues here, you're going to be taking the adjusted NPR at 60. The payment will be set to $42.50. The present value is negative 884.98, which is really what will screw you up. It has to be negative in order for you to figure out the interest rate correctly. The last one is the future value. We always leave set to 1,000. The guess is equal to 2. And we're going to multiply that times 2 to compensate for that semi-annual, giving us a total of F30, which is 0.0968, plus B15, which is our risk premium, giving us a total of 12.68. And I just wanted to highlight a couple of these cells to show you how we calculate that. In order to figure out the payment for this one, we're going to be doing the coupon times that 1,000 divided by 2 for the semi-annual. For the present value, we're going to be taking that bond price times 1.3, or the flotation, times the -1 in order for it to populate our interest rate. Next up, we have our RE, RD 1 minus T, and the RP. The RE is the cost of a new common stock. Let's just highlight that. So what's going on here? We have our D1, which will be the dividend of 1.52. Let's just highlight this. The dividend times the growth rate of 0.07. Don't forget to add the 1 in front of it, so it's actually increasing. Then from here, we're going to be dividing that by 18.47 times 1 minus the flotation cost plus the growth rate. Should give you 17.01. The after-tax cost is the tricky one that everyone kind of messed up, and it's very similar to the retained earnings one we just looked at. We're going to follow the exact same methodology, and all you should be doing is taking that rate of 9.68 and times the tax rate of 1 minus 0.32. And again, let's see that formula for rate. After that, we have the cost of preferred stock, which is very easy to calculate. Basically, it's the dividend divided by the 28 times 1 minus 0.05, or flotation cost. And again, all of this is calculated for you in the sheet. Next up, we have a break point, or break-even point. This is easy. All we have to do is take the retained earnings of $55 million and divide them by the capital structure cost of 55% to get 100. And then once you have all of those numbers, okay, we can now calculate our WACC 1 and WACC 2, which is really what this problem is asking us about. So we know that the capital structured debt is 0.35, the preferred stock is 0.10, and the common stock is 0.55. You'll notice that's also what we use in order to calculate our breaking point. We have our RD1 minus T, the RP, and the RS, which was given to us in the problems above that we figured out. Now, what you're going to use for the RS, he'll usually tell you to use the dividend of the, the discounted cash flow method. For this one, he'll actually tell you which one of the RSs you should do since we have 3 of them available. That should come out to 12.48. The WACC2, the only difference between these is that you will be taking the what is the difference between these? I know we're taking a difference. Is it RE? I think it's a different RE that we're taking. In Memento, I figure out what the difference is between these. And let's just kick that out. Yes, the RS is actually different. So, for this one, we're going to be using B41, which is equal to that cost of a new common stock, where in this RS, B23, use the retained earnings of 15.8. So that's the biggest difference between WACC1 and WACC2. Again, here we're using the cost of a new common stock, the retained earnings at 15.81. This one, we're using that cost of a new common stock at 17.01 as opposed to retained earnings. Now, that should answer all the questions for the first part of it. The second part of it is figuring out all these paybacks and discount paybacks and all this other wonderful fun stuff here. So again, this is available inside the worksheet. You'll see that we've just dropped the new product line, the expanded product line, and basically all those measures that are involved there. Your discounted payback for project 1 should be equal to 4.44. Now the trick for this one is setting this up with, here's your cash flow for the first project, right? And you're going to find the present value of all of these based off the year, right? Then you have a cumulative cash flow, which is basically just adding these two together until you figure out when you become positive. When you become positive, this becomes you're going to use the last negative number and the one to the bottom and to the left of that in order to calculate your discounted payback. And that's the formula right there. We're going to add 4, 1, 2, 3, 4 before it turns yellow, times our cumulative DCF minus 1 there, divided by C28, which was they had 11 million, giving us 4.4, and we'll repeat this for the same project. Again, tricky things with this, you're going to use this as that first number that you plug in, right here, that 4, because that's not counting the initial investment. And then for this one, we can see I'm going to use 2, because I have 2 numbers right there. And you should get 444 and 241 for that. Payback, we should have our very similar to the other one, except we're not compensating percentage-wise with the present value at 3.25, excuse me. Same thing here. We're going to use our project 2, should be equal to 1.9. The NPV and PI and IRR MER crossover rates, they will be equal to NPV. Now don't forget, in order to calculate NPV, we're going to use the NPV formula times, and then add in the -6.5. And in order to figure out the rate, we're actually using the WACC1 from the previous problem. Again, this is all set up in the sheet for you. and that's carried over there. Now you'll notice I use one called the adjusted NPV, and this is in order to figure out the price profit index. The biggest difference here is that you don't include that initial investment back in there. And then we're going to be taking the adjusted NPV and dividing that by the 65 million. IRR, very easy to do. Basically highlight that and use your guess as the WACC. It really doesn't matter what you put in there. In order for your crossover rate, it's equal to 14.72, and the only thing you're going to do is just find the variance between these and do the formulas over again. Mirror, the same way, very easy. Highlight those particular cells and then enter in the WACC as your guess, or the reinvestment rate, and it should look something like that. Now, we go through and it kind of answers all the questions for you based off of what we saw. We have some overall conflicting resolution comments. For this one, the only thing I said was that the size of the project can cause an issue here between NPV and PI, and our different types of measures. The NPV returns the present value of the dollar return. PI measures the present value of the return of each dollar of the initial investment. Mirror and error are measured in percentages and cannot determine the size of the project, causing conflict. It asks us to do a little graph here. Basically, we have 65 million to 20 million. Somebody wrote to me that could be wrong, and you should be using your net present value and not these amounts, but we'll see what I get. The WACC is set to 12.48. The crossover was set to 4.72. And basically, you would choose 65 million because it returns the most off of WACC 1. And for question 9, you would choose 65 million because it turns the most off of WACC 2. And that's our homework kind of in a nutshell. If you have any questions, feel free to comment or call me, and this sheet is available to you. Feel free to give me a call if you don't have a copy of it yet. Thanks, and have a great day.